Okay, so good morning to our first lecture of investment. So yeah, sorry for the delay. I hope everything is working okay now. Yeah, so first lecture. So the plan for today is that we actually first go through the organization of the course, and after that we will start the first chapter. Okay? Good. So as a general rule, whenever you do have any questions, comments, concerns, feel free to raise your hand or also directly interrupt me. Okay? So let me know if there is any problem. So this is general information. My name is Thomas Schmidt. You find my contact information here. I'm located in this building, 8th floor. So if you do have any problems, any questions, concerns, you are very welcome to contact me. Typically the best way of doing that is to write an email first, and then we can see if we can solve it via email, or we can also schedule an appointment. Okay? Yeah, my background is that I lived most of my life in Germany, and I came to Hong Kong in 2015. And yeah, I'm working in finance, and this course I'm actually teaching it now the 7th or 8th time. So I have had some prior exposure to this one, but I'm trying to kind of make things a little bit different every time. So if you spot any problems or also any mistakes on the slides or any things that you find inconsistent, I really encourage you to let me know. Okay? So what is the framework? Yeah, the lecture slides will be on Moodle. So typically I will try to upload them by, let's say, the mid of the week. So you have some time to look at them before the lecture. The lecture will be purely offline. So there will be no live Zoom session or something like that. But I will add the recordings of the lecture on Moodle during the first weeks of the semester. Okay, so during add-on drop-off period, there will be the lecture recording on Moodle, but most likely afterwards we will stop that. Okay, so it's purely offline lecture. Yeah, we have a textbook which is called Investments. So this is how it looks like, and this is how it looks like in like real. So this is a nice book. It's basically, it's the foundation of part of the course, not everything. So especially I would say the second half of the course is more based on the book. The first half is probably not so much based on the book. If you ask yourself the question whether you should buy the book, I mean, it's helpful. Yeah, it's a nice book, but you will not need it to pass the course. Okay, so it's not like, I will not test, for example, stuff that is only in the book, but that was not covered in the lecture or the tutorials. Okay, so everything you need to know, even to pass with A+, you will know that from the lecture and from the tutorials. Okay, so the book is really something that gives you additional readings, background information, additional exercises. Think about it like that. So if we talk about something, especially the more theoretical model parts, and there is a concept that you do not really understand from the lecture, I mean, the book gives you an opportunity to just read about that and slightly, probably the book even gives you a slightly different angle on the problem than what I do. Okay, a different intuition, for example. Okay, so the book is helpful, and just to let you know, currently there is the 12th edition, but to be honest, The change from edition to edition in the last years has been relatively marginal. So if you can get a used copy of 11 or even 10, that would also do it. Okay? Good. Assessment. We will have 4 parts of the assessment. These are final exam, which is the probably most straightforward part. That will be final exam during the examination period. Very straightforward, very standard. So this is nothing to really be surprised about. Okay? Very likely, so I mean, all of that here, what I present here is assuming that nothing crazy happens and we will not go back to some kind of online mode or whatever. So assuming everything is normal, this is the assumption behind all of that. Okay? So final exam will be offline, closed book, standard, final examination. I have zero control over the date or time or whatever, so this is all organized by exam unit. This is completely out of my hands. So this is the first part. The second part will be a term project, which accounts for 25% of your final grade. I will talk quite a bit about the term project in the next slide, so let me just postpone that a bit. We will have a midterm accounting for 20%, and we have a preliminary date for the midterm. I already received some bad news that there are some students already have reported that they have some time clashes for that. So probably we need to change it, but for now, assume we will not change it. So if you do have a time clash on Friday, March 17 from 7 to 8, if you do have a time clash, let me know. Okay? If we have to change it, we will announce that very clearly on Moodle via email to all students, and we will again ask you if you have a time clash on the new proposed date. I know it's annoying, but it's the fact that we have no centralized system for midterms makes it kind of hard to find dates and times when there are no time clashes. Okay? I just want to encourage you to really, once you receive this email, or also now check if you have a time clash and not let us know like 2 weeks before the midterm, because then there is actually nothing we can do. So now we still have some flexibility to adjust things, but not closer to the midterm. Okay? So the midterm will be online or offline, most likely offline. Okay? Most likely offline, so in case online is kind of an emergency option if we cannot find proper rooms or something like that, because the overall class is relatively big. Good. Clear so far? Then we have tutorial participation, which accounts for 5%, but I will not talk about that because Jason, our TA, he's completely in charge of the tutorial, and he will explain to you in the first tutorial how that will be evaluated. Okay? So one thing I also want to mention about the final exam, because in the past that sometimes created confusion. You are aware that there are multiple subclasses of this lecture in this semester, right? I mean, there are, I think 6 subclasses or so. 3 of those subclasses are taught by me, and the 3 other subclasses are taught by Alex Jump. Okay? The only thing that is important for you is to not get confused and worried, because we will have a common final exam across all the subclasses. Okay, so the final exam will be the same for all the 6 subclasses. So sometimes students get a bit worried because they talk to students from the other subclasses, and the students from the other subclasses have covered materials or topics that you have probably not yet covered, and the other way around. So this is really nothing to worry about. The only reason for that is that the way of teaching and also the order of teaching things is different between different subclasses and across different teachers. But at the end of the semester, all subclasses, independently of who taught it, will have the same knowledge and will have all the necessary knowledge to pass the exam with an A+. Okay? So just to let you know, do not worry if you realize that some of your friends in the other subclass, they already learned about something that you haven't yet heard about. You will learn about that later. Okay? Good. So that's a little bit of information about the tutorial, but again, I will not really talk about that because Jason is in control of that. So just for you, this is Jason's email if you have any questions already about the tutorial or any issues. So the tutorial starts February 6th. Standard tutorial, you review the things that we did in the lecture. Of course, you can ask questions and you will have tutorial exercises. Okay? So what is important for you is that there is a tutorial enrollment process and you should check the course website regularly to see all the necessary deadlines and things that are happening there. Okay? So there will be quite a lot of tutorial sessions because we have 3 subclasses, I think in total 200 something students. So we will have like, I don't know, 6, 7 tutorial sessions. Okay, so you need to choose the tutorial session that fits your schedule. So this is the schedule for the semester. So for your understanding, I'm teaching 3 sessions of this course. This session, Friday afternoon session, plus a Thursday afternoon session. Okay, so that's why you also have Thursday here. So today, first lecture, that's very standard. Then of course we have the New Year break. Then we have like 1, 2, 3, 4, 5 regular lectures, or 5 weeks of regular lectures. Then we have reading week. And then there is something I want to attract your attention to. The week after reading week, on Friday, we will have, in all likelihood, the midterm exam, but we will not have the lecture. Okay, so I will actually skip that lecture. And the reason is that for the Thursday subclass, there is no lecture in this week because it's the university holiday. And I want to keep the subclasses aligned. Okay, because otherwise, that also creates an advantage for you. So if you cannot attend your Friday morning session, for example, for whatever reason, you are always free to attend the Thursday afternoon session, for example, because it will always have the same content. Okay? So, then we have regular lectures, and then we actually have a public holiday on Friday, but not on Thursday. So, for this week, we will do content. Also, Friday is a public holiday, and I will let you know how exactly we do that later, closer to the date. So probably I will offer an additional session Thursday evening or something like that, or you can review it online. But this will be kind of the makeup lecture for this week. Okay? Again, how exactly we do it, I don't expect you to be here on a public holiday. How exactly we do it, I will let you know. Most likely I will offer 1 or 2 additional slots during that week. Okay? Yeah, then we have normal lectures. And what I'm trying to do actually is that in the last week, we will not do new content, but I will only do a relatively relaxed Q&A session, probably even online. Okay? So one thing that I try to do from now or since some time is that I move stuff into the semester so that not everything is so bunched at the end of the semester. Okay, because typically students feel very much pressure at the end of the semester. So I try to finish a little bit earlier so that you have more time to review the stuff and also to ask your questions. Okay? So important for you is really only to remember March 17 we will not have a lecture, and in the week of April 7 there will be some special arrangement for you. Okay? Good. Any questions so far? No. Good. So the term project. what is the term project about? The term project is about equity analysis. Okay, so you will act as an equity analyst, and you will write analyst reports. Okay, so the basic idea of this project is really to do something that is quite relevant in practice. That is not easy. So I know that this is kind of a challenging thing to write an analyst report, but I think it kind of helps you to apply the things that you learn, not only in this course, but also from your other courses, into a very practical exercise. Okay? So you will be asked to act as an equity analyst, and you will analyze 3 companies from a specific industry country combination. Okay? This will be a group project, so we will have groups of 5 students, and every group writes 3 analyst reports. Okay? So the formation of the groups is up to you. So I will not assign you to groups. You can freely choose your group. Okay? So you have to find 4 other students and you team up and then you are a group. Then what you have to do is you choose an industry country combination, and then you choose 3 companies in that industry country combination. Okay, so for example, your group could choose, I don't know, the chemical industry in China, or the IT industry in the US, or I don't know, tourism industry in Malaysia, whatever you want. And then you can freely choose 3 companies in that industry country. Yeah? So if I say groups of 5, then I actually mean 5. So this is a strict 5, not 4, not 6, not 7, not 3, not 8. It's literally 5. Okay? And you can form groups across subclasses. So I don't care if you're in this subclass, or in the Friday afternoon subclass, or the Thursday afternoon subclass. So if your friends or whoever is in another subclass, you are free to even form a group with them. Of course, only in my subclasses and not in Alex's subclasses, because they have a different term project. Yeah? So, 2 more things about the group formation as a word of kind of encouragement. It can be a good experience to meet new people and not always choose the same group settings and not always only work together with your friends, but also try something new. So consider also working together with people that probably you do not know so well. That can be an enriching experience. Okay? This is just a word of encouragement. It's still up to you. The second thing I still want to mention here is that if you do face any issues finding a group, I mean, that is not a problem. You can always let Jason know that you don't have a group, or probably you want to be assigned to a group because you want to have like the full experience of a random draw. That's not an issue. You can just write us an email and say we are a group of 2, but we don't have yet other group members or so, and we can assign you to some other group. Okay? So let's see how this works. If we get more, if there are more issues, what we did sometimes in the past, that we also created a Moodle forum that kind of helps you to team up and meet other people. Okay? Good. So, what is the outcome of your group project? I mean, basically 2 things. 3 analyst reports, because you have 3 companies, right? So these analyst reports, I mean, this is just like really random examples. So this is one example for Alcoa. This is just the first page. So typically these reports are 4 or 5 pages long. They have a lot of information about the company, like stock price development, like some descriptions of what the company does. But typically what they have is also like a valuation part. I will talk about the parts that are typically included in such reports in a second. But this is kind of your end product. So this is one, Alcoa, and this is HSBC from a different analyst. analyst company. So these analyst reports look quite different, but this is what you have to come up with. There is no template, there is no clear guideline on how exactly they have to look like. And I will also explain in a second what I want you to take, what I want you to do actually, or what is the most important thing. So this is the first outcome, 3 analyst reports, about 4 pages. Okay? So I want you to hand in those reports at latest on Sunday, April 16. Okay? And again, if we look at the semester, this is roughly here. So again, I try not to do it at the very end of the semester, but a little bit earlier so that not everything is so bunched at the end. Okay? So, after you hand them in, you also have to present your reports. But by presenting, I do not mean you basically just show the reports and read them, so you have to create a presentation, again in a group, for about 10 minutes, where you present the core, the bottom line of your reports. Okay? There is no need to present all the details. You will not be able to do that in 10 minutes. It's really like an executive summary of your reports that you present in class. Okay? So it's just to give you a bit of a mindset, it's really like you assume that you present in front of an audience of interested investors and then you try to pitch certain stocks to them. So you tell them this stock good, this stock bad. So for the presentation, there's not a lot of rules, but one thing I really want to make sure is that actually every group member participates in the presentation. Okay? So another way of saying that is like really, I want to hear the voice of every student at least once in the semester. Okay, so I will not watch with a stop clock and just say, oh, everybody has exactly the same speaking time or whatever. The only thing is participate. So one student can take care of the questions and the other 4 present. One student can take the introduction, can make the introduction, and the other 4 do the main presentation. I mean, all of that is fine. That's up to you. But everybody has to have an active role. So when will we do the presentations? Well, actually, we will do them in the second last week of the semester, which is April 17 to April 21. And we will have multiple sessions. And each session will be 60 minutes and have 5 groups. Okay? Of course, you do not have to attend the other sessions, you only attend your session. So in this week, we will have regular lecture plus presentation. So the presentations will take place, the sessions for the presentations, that will be your tutorials. So there will be no tutorials in that week. So we will basically take the tutorial sessions, plus I will open several additional sessions in the evening times. Okay, so that will be a week where we have a lot of stuff. But for you, it's like really only your presentation and the lecture, but no tutorial. That's your schedule for this week. Okay, so you do not have to restrict your group to people from within your tutorial, obviously, because we will have multiple sessions and you will be able to find a session that fits the schedule of all of you. Okay? So how that will work is that once we finalize everything closer to the presentation date, we will open kind of something, think about it as a Moodle survey, and then every group has to sign up for a specific session. Okay? So again, the group formation is not restricted to the subclass and or the tutorial you're in. You can freely choose your group across all subclasses and across all tutorials. At the end, we will have to make sure that every group finds a time spot that is convenient for them. Okay? But I'm sure that will be okay because especially in the evening times, typically you do not have other tutorials or lectures. Good. So I think it's kind of obvious. So the intention is really to do something that is quite relevant in practice, writing analyst reports, understanding companies in a way that you really have an opinion about them, whether they are good or bad investments. And you should show that you can do something like that based on your academic knowledge. Okay? It's not easy, so this will be kind of a challenge. And part of the experience, I hope, will also be to see how much all of that depends on your assumptions and how many assumptions especially you have to make so that you can really come up with a recommendation of buy or sell. Okay? And if this is the outcome, I think it's a pretty good one, because that is actually the same situations that analysts in reality face. They have to make a ton of assumptions so that they can arrive at their result. Good. So a bit about the further procedure here. So grading, yeah, is obviously mostly based on group performance. But if we would feel that during the presentation one group member was especially outstanding, we would adjust the grade a little bit upwards. And if we would feel that one group member has very little knowledge about the content of the presentation, we would accordingly adjust the grade downwards. Okay. Yeah, so form groups, that's what you have to do now, form groups. And the deadline is February 12th, but there is really absolutely no reason to wait until that long. I mean, that's just like latest. So you can do that now, or after the lecture, okay? Then you send an email to Jason with your group members, student IDs, names, and your preferred topic. And again, topic would be an industry country combination. Yeah? So for a little bit of, for both selfish and not so selfish reasons, we restrict every industry country combination to every industry country combination is available only once. So that the selfish reason is that Jason and I will listen to all of your presentations. So if we hear evaluation of whatever, Microsoft all the time, it's getting a bit boring. So every group will have a different industry country combination. Okay? So the way we do that is simply first come, first serve. So when you write an email to Jason with your group members and your industry country combination, there are two possible outcomes. Jason will say yes, then you can start working on it. Or Jason will say, sorry, this industry country is already gone, choose another one. Good. Once that is done, and once you have your industry country combination, you can freely choose the 3 companies. You do not have to get approval for that. That's really up to you which companies to choose. And you can start working on it. Okay? So, I mean, as a usual kind of encouragement, do not wait until the very last and do not wait until very close to the deadlines. Start working on your term project relatively early in the semester. Okay? The second thing is, there is often a question, which industry country combination should you choose? I mean, it really depends on the group. So probably you have some special interest in a specific industry or country, or you probably even worked for some industry, or you worked in a specific country or so. So if you have some interest or experience, I mean, that's kind of a natural choice, but it's really, there is no rule for that. It's also not the case that there are industries that are especially good or bad for doing analyst reports. Okay, so like I've done that multiple years, and I've seen very good reports for traditional industries, like chemical industry, car manufacturers. But I've also seen very bad reports for traditional industries. And I've seen very good reports for more fancy industries like, I don't know, fintech or whatever. But I've also seen bad reports for those industries. So the industry really does not determine your grade and or the quality of your work. Okay, so really choose what you find interesting, and there's no need of trying to be strategic and choosing an industry that is fancy or something. I mean, it really will not affect your performance. Okay? So this is a very, very short overview on what an analyst report could look like or typically includes. So the basic idea is that an analyst report gives investors an overview on the company and helps investors to decide whether they should buy or sell the stock. I mean, that's the ultimate target, right? So the final recommendation of the report is always a buy, a sell, or a neutral, okay? So buy the stock, sell the stock. A neutral basically means that you don't know. So it could be fairly priced on the market, so just do nothing. If you hold the stock, keep it. If you do not hold the stock, don't buy it. So how can you come up with a recommendation like this? I mean, it's really very, very different how different analysts and how different analyst reports look like. It's not like there is one template or one structure or one size fits all approach. I mean, that's not the case. So what this here shows you are possible sections that are often included in analyst reports. So something like an overview is typically included. It's like key financials, descriptions of recent developments, a description of the business risks, past price developments like the beta, a comparison with industry peers, and what actually all reports include is some kind of a valuation part. Because the valuation part will probably be the most powerful tool that allows you to come up with a buy or sell recommendation. So basically the idea behind the valuation part is that you come up with your own value of the company, which is called the intrinsic value. So you try to find the real value of the company based on some valuation model. We will talk about valuation models in the lecture. So for example, you take a multiples valuation model or approach, you come up with a value of the company according to your approach, and then you compare that value to the current market price. And if the value according to your model is below the current market price, you would recommend a sell. If the value according to your model is above the current market price, you would recommend a buy. Because then the market price is too cheap, right? So you can buy something that has high value for a low price. So the valuation model is typically a very, very important part of an analyst report. But we will also see that doing valuation is a very frustrating experience because you will need to make a ton of assumptions. A lot of assumptions, and it's like not a very precise science. It's like really, if you try 3 or 4 different models, you will have 3 or 4 different outcomes. That's okay. I mean, that's how these things work also in practice. I mean, also like actual analysts in practice, they are no magicians that come up with a value and they exactly know that this is the true value. They also run the same models and they also have to make these assumptions. Okay? And really part of the learning experience, I hope, is that you see how fuzzy these models are and how difficult it is to run this model. So which I think will also allow you to have a better interpretation of the outcome of the models that other people do. Because you will know how many assumptions they had to make and how sensible the outcome is most of the time to these assumptions. Okay? So the valuation part will be an important part. So based on that, you then come up with a buy, sell, or neutral recommendation. And if you ask what is a good and what is a bad analyst report, the very simple answer is if you convince the reader that this is really a buy or a sell, then it's a good report. If the reader is really convinced, if the way of arguing in your report leads to a high level of trust of the investor, I mean, that is a good report. Because the reader thinks, oh, this guy really knows what he or she is doing. A bad report is you read it and you have no idea what's going on, and at the end you say, oh, buy. but you have no idea why you should actually buy. That's a bad report. So be as convincing as possible in your recommendation. Another thing that I just want to mention is it's really not like there are really different ways of coming up with a convincing recommendation. Okay? So valuation is always kind of part of it. But you can make your report relatively quantitative, or you can make your report relatively qualitative. Okay? So there are really different styles. I mean, also, just if you look at my two examples here, this looks like a relatively quantitative report. A lot of numbers, a lot of lines here, and okay? Just by looking at it, this is a much more qualitative report, much more descriptions, less numbers. It's really not the case that the one is better than the other. Okay? It's really a matter of taste at the end. So if your group feels more comfortable doing a more qualitative approach, that's perfectly fine. If your group feels more comfortable doing a more quantitative approach, that's also perfectly fine. Okay? So similar to the topics, in the past I've really seen very, very strong, excellent quantitative reports, but also bad ones. And the same is true for qualitative reports. So which type of report you do has very little predictive power on the quality of the report. So I just want to encourage you to do what you feel is the best, or what suits your taste better, or also your abilities. Some people are better in quantitative stuff, some people are better in qualitative stuff. Okay? There is no one-size-fits-all approach here, and part of the challenge will be to decide your own style and to decide which sections you want to focus on. Okay? That's part of the experience. And I will not provide guidelines here. I will not tell you do this or that. Okay? Yeah, the presentation, I think this is quite clear. Basic idea, you present the bottom line of your reports. You don't present everything in the report, obviously. So especially if you have like a valuation model, then you wouldn't present all the tiny assumptions and all the numbers or so. You can always refer the audience to your report for the details. Basically, you just present the bottom line. Again, a good presentation gives the audience the impression that you really know why you recommend buy or why you recommend sell. Okay, so that's the term project. Any questions about that? If not, then we'll do the last 2 or 3 slides and then we have the break. So for the introduction chapter. So the first part, the first unit, the first part of the lecture, which is called fundamental knowledge, it could also be called introduction. I will try to give you a bit of a framework and a bit of a general view on the investment environment first. Okay? So what are financial assets? What are real assets? What is the investment process? How do these things work? Then we will talk about different asset classes. So which asset classes exist? What instruments exist within those asset classes? So what is actually the things that I can invest in? So we will talk about the obvious ones like equity. But we will also talk a little bit here about things that probably are not so well known, like money market instruments, repurchase agreements, things like that. Okay? And then the last part of this introduction chapter, also the biggest one, will be on the trading of securities. So how are securities actually traded? What is the process of trading them? So where are they traded? So historically regulated exchanges, New York Stock Exchange, Hong Kong Stock Exchange, but more and more also other places, like OTC trading, dark pools, things like that. Okay, so we will talk about that. Different types of transaction orders. So if you buy a stock, how do you instruct your broker to buy the stock for you? Do you have like a market order saying that buy whatever the price, or do you have some price contingent order saying that to your broker only buy if the price is below X? And then we will talk about some special forms like buying stock on margin, which means that you use your own money to buy the stock, but additionally you borrow money from your broker and you also invest that borrowed money. So it's basically a strategy to get a leveraged position because you're not only investing your own money, but you also invest borrowed money. Okay? And last part will be short selling. So the introduction chapter here, that will be quite qualitative. So we will not really talk a lot about models, about theory here. So we will do a bit of calculations. We will calculate, for example, stuff when we talk about margin buying, short selling. But especially today will be relatively qualitative, more descriptive, if you want. Okay? We will get much more quantitative, much more theory-like in Unit 2. So in Unit 2, we will move on from our general introduction to probably the first core part of the lecture, which is portfolio theory. Okay? So first, I will start with a relatively simple overview on portfolio statistics. And I say simple because most of that is something that is already known to you. So most of that should be not new. Standard deviation, variance, covariance, correlation. How do we calculate those things? And I will show it to you, especially in the context of portfolios. But the core concepts, you all know that. That's basic statistics. Where we probably go a little bit beyond the basic statistics is when we think about how can we actually calculate those numbers in reality. Okay? Mathematically, it's not difficult to define a standard deviation. But if I ask you to calculate the standard deviation of the returns of the, I don't know, Microsoft stock, you have to make some decisions. Right? What are the key decisions you have to make if I ask you to calculate the standard deviation of a stock? Any ideas? What are the key things you have to decide? Like in practice, you really want to go out, calculate the standard deviation of Microsoft stock. Yes. The time horizon, right? How far back do I go in time? And this is probably the toughest one. Because there's a big trade-off. If I use a very short time period, if I only go back, let's say 6 weeks, there's a lot of noise. It's not clear that these 6 weeks are representative for the stock of Microsoft. So let's think about the other extreme. I go back 30 years. Well, it's not so clear that the stock 30 years ago has anything to do with the stock now. It was probably a very different company in a very different time. So probably we have an estimate that is not very noisy, but it's also not very right. So this is the trade-off. And I'm not saying it's not about what is the right answer, I'm just trying to give you the trade-off, okay? And that's the first very important question you have to ask yourself, how far back do I want to go? The second is, what time frequency do I use? Do I use daily data? Do I use hourly data, which is sometimes available now? Do I use weekly data? Do I use monthly data? What do you use? Again, there are trade-offs, and we will talk about that. And yeah, even probably the most basic thing is, do you use stock prices or do you use returns to calculate the standard deviation? Right, stock prices give you a time series of numbers, and in statistical terms, you can easily calculate the standard deviation. And the returns of these stocks gives you numbers, and you can calculate the standard deviation. So typically, we always use the returns and not the raw prices. Okay, and I will also talk a bit about that in this chapter why we do that. Yeah, so this is portfolio statistics, still pretty close to what you know, I would say. After that, we move on to the first real theory chapter, I would say, which is called capital allocation to risky portfolios. And in this chapter, what we try to do is we try to understand in a very simple model world. So in our model world, we will only have two assets, two possible investments, a risky one and a risk-free one. And we will try to answer the question how much you optimally invest in the risky asset and how much you optimally invest in the risk-free asset. And that will depend a lot on your level of risk aversion. So then we will try to come up with a formula or a metric or a standardized approach on how we can incorporate your level of risk aversion into that decision so that we can actually really calculate things. And that will be the utility function. So the utility function will be a tool for us to attach a utility to risk-return combinations. So if you have a specific combination of risk and return, let's say you have a expected return of 5% and a risk of 20%. So standard deviation of 20%, expected return of 5%. This investment, this risk-return combination, is not equally attractive to all people, right? Because some people have a very high level of risk aversion, so they really, really hate risk. So they will say, no, this thing is risky. Take it away, I don't want it. Other people will say, oh, that's a pretty good investment because they can tolerate risk better. Okay? And this will be risk aversion utility functions. And at the end, we will try to answer this question, how the risk aversion affects our optimal portfolio, which is a combination of the risk-free asset and the risky asset. And obviously that would not be the same, right? And this is a complete theory chapter, completely theory, completely model world. But of course, I mean, the question or also the outcome is quite close to practice. I mean, if you think about your risk tolerance or risk aversion and risk aversion of your grandparents, you will choose rationally very different portfolios than your grandparents because your risk aversion is much lower than that of your grandparents. You can tolerate some losses. You have a long investment horizon. But if you are close, if you are close to your retirement or even already retired, I mean, your risk tolerance typically is much lower. And you rationally choose very different portfolios. Okay? And the core economic foundation is this. And the nice thing here is that we will not be only able to say you choose different portfolios, we will really be able to quantify it. So how much different is the portfolio? And then in the third unit, we will actually become a bit more, we will try to take this super simplified model world with only two assets and make it closer to the real world where we have, of course, probably millions of assets. So we will introduce multiple risky assets and then we will see how all that changes. So we will first try to understand what the optimal investment is in a world where we have multiple risky assets. So assume there are multiple risky assets, and in which asset do you rationally invest? Or in which combination of assets? And I mean, that's a lot of jumping ahead, but the most probably surprising result, which is the underlying foundation or idea behind the most important model in modern finance, which is the capital asset pricing model, is that all investors, independently of their level of risk aversion, will choose the same risky portfolio. So there will be one risky portfolio which consists of multiple risky assets. And this one risky portfolio will be the optimal choice for all investors, for you and for your grandparents. The difference between you and your grandparents is that you would invest a lot of your money in that risky portfolio and only a tiny bit in the risk-free asset, and your grandparents would invest a lot in the risk-free asset and only a tiny bit in this optimal risky portfolio. Okay? But the portfolio, according to the portfolio theory, the risky portfolio, that would be the same. So this is one of the most important results that is underlying a lot of the modern finance models, which is called the Tobin separation, and that will be, yeah, pretty much the core here. Then we will talk about index models, but I skipped that for now. Then we talk about these models, capital asset pricing model, what is the foundation, how do we derive it. The thing is, if you understand portfolio theory well, then capital asset pricing model is something that is very easy to understand as well. Okay? So we will apply it, we will talk a bit about equity valuation. We will extend that, or we will talk about the second class of asset pricing models, which is called the arbitrage pricing theory, and we will talk about market efficiency. Okay? So market efficiency meaning how well do markets incorporate information. And this one will be an especially interesting chapter because it's closely related to your term project, because what you actually try to do if you write analyst reports is that you try to beat the market, right? You try to find undervalued stocks. If markets have a very high level of efficiency and if all information is already priced, it's actually not possible to beat the market. So we will talk about market efficiency and whether it makes sense to write analyst reports or not. And I can reassure you, we will find some solution that makes your work not meaningless. Okay, that makes it actually meaningful. Even if markets are relatively efficient. Good. Let me talk about funds, investment companies. We will talk a bit about ETFs, which are pretty important nowadays, exchange traded funds, passive investing, and we will talk about portfolio evaluation. Okay? So this is just a very short preview of what will come in this semester. Any questions? Good. Then let's have 10 minutes break and then we will continue. Okay, so good. So any other questions about term project, lecture, outline, framework? Good. So for the recordings, I plan to put them online after all the sessions are done. So that means Friday evening, approximately. Okay? Good. First, real content. So we are talking about fundamentals. We start with the investment environment. Okay? So when we think about investing, something that is kind of worth to remember is what investing is actually about. Because at the end of all, when we invest, right, we always invest in financial assets. But at the end of the day, like financial assets are always related to real assets. So what are real assets? I mean, this is land, buildings, machines, basically the productive capacity of a country. And financial assets are claims on these real assets in some way or another. Like an equity, a share, is an ownership stake on a real asset. A bond would be the claim on the cash flow that is generated from a real asset. So for some financial assets, especially derivatives, it sometimes becomes a bit tricky to see where the real asset is actually located at, because you need to go through multiple chains and layers. But still, at the end of financial assets, at some point, we will end up at a real asset. So, having that in mind, I want to show you a little bit about the growth of financial assets over time. So what this picture here shows you is from 1990 to 2012, and there is newer data available, but it's not as detailed as this one, unfortunately. So for this time period, 1990 to 2012, it shows you the global stock of debt and equity, the global stock of basically financial assets, okay, in trillion US dollars, inflation adjusted. No, I think it's not inflation adjusted, sorry. Trillion US dollars, okay? So in 1990, the global stock of debt and equity was 56 trillion US dollars. That has grown to 219 trillion US dollars in 2010. So over this relatively short 20-year period, the stock of financial assets quadrupled, like factor 4, right? 4 times as much as high in 2010 as in 1990. So a tremendous growth of financial assets during that time period. So people sometimes, there was like quite some discussion about that in the 2000s and early 2010s about what was called the financialization of the world. Because people had the impression that more and more is about finance and financial assets. And this was driven by just this impression that the growth of the financial assets was so incredible. Factor 4 within 20 years. 50 to 200 trillion US dollars. So undoubtedly financial assets grew a lot. Okay? I think the interesting question now is why they grew so much. Okay? And to understand that, we have to link financial assets to the real assets again. So what the last line here does is to set financial assets in relation to GDP. And GDP is a proxy for real assets, the real economic activity of a country. Okay? So basically the last line here shows you financial assets divided by GDP. And what we find then is actually that there is still growth, but the growth is not super dramatic. This ratio was 263% in 1990, and it grew to 335% in 2010. Okay? So 263 to 335. So that's what? 25% growth or something like that. Okay? So very different from what we find when we only look at financial assets. We're not talking about factor 4 anymore. We're talking about still a growth, but not like an explosion. Okay? So what people often overlooked when they talked about this growth of financial assets and everything becomes financialized and finance industry is basically taking over the world, that's kind of the subtext that you often felt, is that the growth of the financial assets was actually fueled by the growth of the real assets. Because economies in this 20-year period were growing so much, it was only natural for financial assets to grow as well. Okay? They grew disproportionately faster. So this ratio went up. I'm not doubting that. Okay? But it's not an explosion. It's a growth. Okay? So that's, I think, the first important thing we can learn from this picture. Financial assets grew like crazy, exploded, but this explosion was driven by an explosion in real assets. Relative to real assets, they were also growing, but at a, I would call it a moderate pace. Okay? So this is the time trend here. The second thing I want to show you in this picture is actually the composition of financial assets. So let's just look at, I don't know, probably we stick to 2010. So the total financial assets is 219 trillion. Okay? Now we can divide that into different classes: equity, government bonds, financial bonds, corporate bonds, securitized loans, non-securitized loans. So basically the highest level distinction here would be equity and debt. Right? Equity is only what we call equity here, and all these other classes here are fixed income, are debt. So if you think about that, I mean 219 trillion total stock, and only 54 trillion are related to equity. So equity globally accounts for less than 1/4 of all financial assets. Approximately 3/4 of all financial assets are fixed income instruments, are debt. And this is something that sometimes comes as a surprise to people, because we often get the impression from the media and from the news and from talking to people that equity is the big thing. Right? Because there's a lot of coverage of equity, and newspapers write about stocks, and like we pitch stocks, and the banks talk about stocks, and it's all about equity. Fixed income is kind of not very much talked about. But in terms of volume, that is much more important than equity. Okay? Global stock of financial assets, less than 1/4 is equity. More than 3/4 are debt. Okay? So that's something we should keep in mind. And then, of course, we can go one step further and also divide the fixed income, the debt, into different types of debt. I don't want to go through that now. I mean, I just wanted to make these two big points about the growth and about the fact that equity accounts for only less than 1/4. If you do the distinction, you find that basically you can further classify debt into bonds and loans. Sorry. What is the difference between a bond and a loan? There is one core difference between a bond and a loan. Both are fixed income, right? Both are debt. What means fixed income? Well, simply, in the contract, it is written what will be paid in the future, right? That's why we call it fixed income. So if you have a bond or any debt instrument, the contract says in 1 year, you will get $100. In 2 years, you get another 100. In 3 years, you get another 100. And in 4 years, you get 1,000 or whatever. And as long as the issuing entity doesn't default, I mean, that's what you get. That's fixed income. Equity is different, right? I mean, in equity, if you buy a share, nobody tells you what exactly you will get in the future. Probably you get a dividend. Probably not. It's not fixed income. But within fixed income, we distinguish between bonds and loans. So any guess what, or anyone knows what the major difference is? Yeah, that's the right direction. Bonds are publicly traded and loans are private contracts. Right? So bonds are traded at a marketplace, and you can invest in bonds if you are an investor. I can buy a bond issued by the US government. I can buy a bond issued by the Hong Kong government. I can buy a bond issued by Cathay Pacific or whoever I want. There's a marketplace for that. That's not exactly the case for loans. Loans are private contracts between mostly banks and borrowers. So for example, if HSBC Bank grants a loan to whatever firm, Cathay Pacific or another bank, yeah, I mean, you cannot invest in that loan. It's a private contract between HSBC Bank and the borrower. There is no marketplace for that. It's on the book. It's in the balance sheet kind of HSBC. It's not traded. Okay, so that's the big difference. A loan is a private contract between the lender and the borrower, and a bond is a publicly traded fixed income security. For loans, this is kind of the core distinction. Then there are exemptions and kind of ways around it a little bit, but that's the core distinction between a bond and a loan. Okay? Good. So when we talk about financial investing, financial markets, remember, we are still, this is like a very general, top-level overview introduction, okay? So when we talk about financial markets, let's also think a little bit how financial markets affect the economy. And if financial markets or investing, if you want more generally, if that is good or bad for the economy, okay? And although this question seems very obvious, so the question whether financial markets are beneficial to the real economy or not, actually there is not a lot of really good causal evidence on that. It's very hard to really answer the question whether well-developed financial markets help the real economy or not. Okay? What we find always is a very strong correlation between both. So countries that have a very well-developed financial market, they also have very well-developed real economies. Okay? But this correlation does not necessarily mean that there is a causality, right? Because it could simply be that if you have a successful economy, you can afford to have a large financial industry and a lot of well-developed financial markets. It's probably going from the industry to the financial markets and not from the financial markets to the industry. Okay? So the point why I'm mentioning this is just, although this question seems very obvious, if financial markets are beneficial for the economy or not, we do not have a lot of very, very good evidence on that. Or let me put it even slightly differently. Answering this question empirically is pretty challenging. Okay? So if you think about potential reasons why financial markets probably should benefit the economy, we can think about a couple of them, and this is not all of them, this is just an overview, or just some examples. So what is often argued is that financial markets fulfill a very important information role, because they allow funds to flow to the companies, or more generally to the borrowers, with the best prospects. Okay. And if you think about that for a second, that makes a lot of sense. I mean, imagine a world without a financial market. There is no banks too, so there is no banks, no financial markets. So, and now you have some money. You have some excess cash. So you want to invest your excess cash. So what can you do? I mean, probably the best thing you can do is you can ask all your friends or family, hey, I have some money, probably you want to buy a house, or do you probably start a business, or do you need some money and I can lend it to you and you pay me an interest rate or something like that. So, but basically you can only ask in a very limited amount of potential borrowers, right? The financial market actually now extends the set of potential borrowers to a nearly infinite amount, because it matches all borrowers and all lenders in a market. It matches supply and demand. Okay? So that's kind of the information role. Without financial markets, we have a limited set of potential users of our money, and they are most likely not the best ones. Okay? The financial markets now open that and increase that tremendously, because now suddenly we know exactly who is looking for money, and then we can exactly choose the one that we find the best. Okay, it's much more transparent. Yeah, consumption timing, that is also something, if we have a well-developed financial markets, what you can do is you can purchase securities and store money over time. Yeah? Think about the opposite. If we have no financial markets, if we have no banking system too, I mean, how do you store wealth? It's not simple. Probably you can keep it as cash, but then you get zero return. And assuming even moderate level of inflation, I mean, your wealth will decline substantially over, let's say, 20, 30 years. So let's say you want to inherit money to your children. Without financial markets, that's nearly impossible, because physically storing the cash is just not an option, because it becomes, due to inflation, worthless in a generation or so. So financial markets allow you to store wealth and transfer consumption into the future, probably even to your children or your grandchildren. Yeah, and it allows also better allocation of risk. So investors, if you have financial markets, again, this is related to one, they have this broad range of potential investments. Yeah? So now you can choose exactly the investment that fits your risk taste. Again, if we have no financial markets, probably you even know somebody who needs money. Yeah? But this is a friend, and this friend has no steady income yet, so you think, oh yeah, this guy would need money, but that seems pretty risky. I mean, probably I shouldn't do that. And now with financial markets, you have all the potential investments. You can choose exactly the risk level that you want. So similar to what we said before about you and your grandparents, so probably still you invest in a young startup or a high-tech firm that's pretty risky, but your grandparents can buy US treasuries that are not very risky. Okay? So everybody can find an investment that fits her own risk appetite. The thing, so this now, again, this is not an exclusive list, so there are more potential reasons. So this all sounds pretty good, but financial markets are not all good. I mean, they also lead to problems, and they also come with some issues. And probably the biggest issue is agency problems. Okay? Traditionally, like if you have no financial markets, I mean, how is a company organized? Very simply, right? I mean, you have an owner, and the owner runs the company. Okay? So this is the base case, in a sense. This is the traditional way of doing it. Now you have a financial market, and this often leads to a separation of ownership and control. Because of the financial market, you can sell parts of your company to investors, and now, let's say you are the founder, you still run the company, but the company is owned by different people. Or, like this is, let's say like Facebook, Mark Zuckerberg example, I mean, he is still running the Meta thing, but it's mostly owned by other people. Okay? As soon as you do have the separation of ownership and control, there are a lot of potential problems. Okay? Because the manager who runs the company, this guy might have incentives to cheat. Let's say I'm running the company, but it's not my company. I want, for example, I have a lot of utility in having a private jet. So I buy a private jet for the company. I probably don't need it, but it's nice for me to have. And it's not my money, I'm burning the money of the owners. So I don't care. And even worse, you could literally cheat in the sense that, oh, actually the company is not doing very well, but I want to keep my job, so I just cook the books a little bit and make the numbers look a little bit nicer so that the owners are all happy and they still pay me my salary. Of course, at some point this will explode. But again, you're not the owner. If the company crashes and defaults, I mean, you say, oh, sorry, but you're not losing your own money. So separation of ownership and control creates a lot of problems. And probably this is really what gives rise to all these scandals that we have seen also in the last 20 years, to these governance scandals. Okay? So there has been a lot of issues about corporate governance, about scandals, about fraud, and investors lost a lot of money. And again, many people believe that the core problem here is, and this is very much related to the existence of financial markets, the core problem is the separation of ownership and control. So we have seen a lot of accounting scandals. Just want to show you a few examples, probably the ones that are interesting. So this is, I don't even know how whether we should call it an accounting scandal or not. So this is the case of Wirecard. Probably, who has heard about Wirecard? At least one. So Wirecard was a pretty famous German bank. It was not a traditional bank. It was like a bank that focused more on, probably you could even call like fintech-like banks, so more on modern payment solutions. It was not the classical commercial bank, you deposit and they grant loans. It was more like a fintech company. You can think about it like that. Okay? And it was, and I think it's fair to say that it was kind of everybody's darling. So everybody thought very highly of this firm, and it even became part of the largest German corporations, the DAX. And yeah, it was like a very, 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 very prominent company until it wasn't. So then, approximately 2 years ago, suddenly it became obvious that they were engaging in massive fraud. So at some point they admitted that 1.9 billion euros of cash were just not there, was kind of missing, just disappeared. And I mean, the CEO was arrested. This is the CFO, Jan Marsalek. So he is on the run. He kind of escaped. And until today, it's not totally clear how much money they have stolen, but it is pretty clear that investors lost nearly all of their investments, and that this was a massive fraud scheme that was going on. Actually, even businesses that they claimed to exist, they did not exist. Money that they claimed to exist did just not exist. So massive, massive fraud. Okay? And I'm just spending a couple minutes on this case because I think it's really important, if you think about investments, to keep in mind that these things can happen. And again, this is not a small company. This was one of the larger German companies. This was audited by professional accounting firms, and none of them detected the fraud that was going on. Okay? So things like that do happen. So probably the prime example of fraud was Enron. I'm sure all of you have heard about Enron in some kind of context. So Enron were in some ways is similar to Wirecard. They also were everybody's darling. They had a very innovative business model, like trading of energy. Yeah, at the end it turned out that their whole business model was faked. So they never made, they were never as successful as they claimed, and probably they never really earned a lot of money, although they claimed they did. So we should be aware of those cases. Financial markets give rise to governance problems, and people are sometimes motivated by greed or whatever, and they exploit they exploit the fact that there is a separation of ownership and control, and they can steal money, but it's not their money. if he would have owned Wirecard, I mean, who should he steal money from? And it would be his own money, it's his company. But the fact that the investors in Wirecard were like small private investors, funds, I mean, he stole their money. Okay? Yeah, we can skip this one. And this one is an interesting case that I just want to show because it's a nice illustration that fraud is not only happening at the top levels, fraud happens everywhere. And this case is also nice because it shows how simple it sometimes is to cheat. Okay? So this is the case of Longtop Financial Technologies, which is a financial software company. And they were audited by Deloitte. Okay? Deloitte did the auditing and they did the due diligence. And kind of this company, this is the short version, they said they had some money on a local bank account. Okay? So what Deloitte does, this is usual procedure, they call the local bank branch and say, hey guys, we are doing the auditing for Longtop. We just want to confirm that they have this and that amount on their bank account. And then the bank over multiple years would say, yeah, that's true. Okay. Deloitte said, okay. Next company. Audited. So until Deloitte became a bit suspicious because some other things didn't really add up, and then they didn't call in the next year, they did not call the local bank branch, but they called the headquarter of the bank. And then the headquarter of the bank said, oh no, sorry, there is no money on that account. So basically what they did is they just colluded with one or two persons at this local bank branch. And the local bank branch persons then just told the auditor, yeah, the money is there. And that was enough to keep this scheme going for multiple years. So auditing is not able to detect a lot of fraud. That's something we have to keep in mind. Auditing has a lot of problems. It's relatively easy to circumvent those things. You just need a few people in the right places and so on. So fraud is everywhere. So when we invest, especially in smaller companies, we should be very much aware of that. And I'm not saying that in any way to encourage you to engage in fraud. I'm just saying you that from the other perspective, if you invest, be aware. Don't think that the fact that something is audited is 100% proof there is no fraud. It isn't. There are many counterexamples. And like in the Wirecard case, the Enron case, about this case I don't know so much, but in Wirecard and Enron case, investors lost a lot of money. Billions. Okay? Good. So now kind of we're zooming into the investment world. So now we're not talking, let's talk a little bit about the investment process. In the investment process, we can broadly distinguish two steps. The first step is called the asset allocation, and the second is called the security selection. Okay? In the asset allocation step, what we have to do, and now we consider you are either a private investor or a portfolio manager for a fund, doesn't matter, it's always the same. Yeah? So what you have to do is you have to choose how much money you want to invest in broad asset classes. So which asset classes do you think are important, or which important asset classes can you think of? Examples for asset classes. I start, equity. What else? Fixed income, yes. What else? Yes. Equity, fixed income, real estate. What else? Cash, very good. Yes. Number 5. So there's a lot of them. I mean, it's kind of always a discussion what are the most important ones, but what else could you think of that most people kind of consider important. So those are already the most important ones. Any other ideas? Yes, commodities. And then you could even think about things like hedge funds or venture capital, or things like that, private equity. So there is no clear distinctive list of asset classes. So I'm just showing you this here, and they use a very detailed distinction. But by and large, it's cash, equity, fixed income here. Then they have real estate, they have commodities here, and they have some special stuff here, like buyout funds, venture capital, hedge funds. Okay, so this here wouldn't be really relevant if you're a private investor, because it's not so easy to invest in that. But this would be more relevant if you are like, I don't know, a family office, or you have a lot of wealth and you're a private wealth manager or something like that. Okay? But that's the first step, choose the broad asset classes. And if you think about that, I mean, that is already quite powerful way of adjusting also the risk of your fund or of your investment in general. So this is Sun Life, and they have a fund family. So they have different funds, they are kind of connected. And the difference between these funds is really their asset allocation. So for example, for the Sun Life conservative fund, most of their asset class is fixed income. The largest asset class is fixed income, and then they only do a bit of equity. And then in their most aggressive fund, which they also call aggressive fund, they only have a tiny bit of fixed income, and most is actually equity. Okay, so it's really a way of adjusting the riskiness of your fund. So once you have chosen your asset allocation, what you do is that within each asset class you select the securities. Okay. So how exactly you do that? Let me get back to that in a second. But one way to do it is really the traditional way to do it is really what you are actually also supposed to do in your term project. You basically look at all the potential investments, and then you choose the one that you consider undervalued. Okay? So you find attractive investments. For example, your asset class is US equity, so you find attractive US equity. As simple as that. And this would look something like this. This is a specific fund, which is kind of Germany oriented, but not only, it's a worldwide fund, but it has some focus on Germany. It's called the Artisan International Fund. And among there, they have a like equity class, asset class, and then they have chosen to hold a lot of Deutsche Börse, 4.9%, Linde, 4.9%, Allianz, and like funnily kind of also they have a lot of investment in Wirecard, which probably wasn't the most successful ever. But also some other companies. Okay? So within the asset class, they choose specific securities. Good. Yeah, so that's pretty obvious. I mean, of course, there's always a risk-return trade-off. So if you choose securities, we should always be aware and keep in mind that higher expected return always goes along with higher risk in markets that are somewhat efficient. Virtually all modern markets are somewhat efficient, so you can safely assume that this picture holds. Okay? So, for example, if the risk-free interest rate, the US, let's say the US Treasury is risk-free, okay, US bonds are risk-free, but which is not true, and I get back to that later. But let's assume they are risk-free and they give you a return of, let's again say 2.5%. And somebody tells you, look, I have a risk-free investment for you. It gives you a return of 10%. That's just not happening. I mean, if somebody tells you that, then it's fraud. Because if you want more return, you have to accept a higher level of risk in somewhat efficient markets. And somewhat, every market, even like Bitcoin or stuff like that, is somewhat efficient. Okay? Good. If markets are somewhat efficient, there are still two ways of investing, active and passive. Okay? Whether active or passive is better at the end kind of really depends on your view on the actual efficiency of markets. I mean, somewhat efficient, okay, but are they fully efficient or not? That's a more difficult question to answer. Somewhat efficient, yes, I mean, everybody would agree. Fully efficient, unclear. Why is this so important? Well, think about the two possible investment strategies. Basically, these are the ways of selecting the securities within an asset class. So remember, we did step one, and now we want to select the securities. Active and passive. So what is active? Well, active is what I just described. You try to basically outperform the market. Okay? How can you outperform the market? Two basic strategies. One is you select securities that are undervalued, so you can buy them for a too cheap price, and you hope that over time the market price approaches the true value and you can sell them for a high price. Okay? So that's security selection. That's basically what you do in your term project. You try to come up with a list for a specific stock. You answer the question whether this stock is undervalued or not. The second way of doing active management is market timing. So instead of finding securities, you could also just buy all the securities, but you are not holding them all the time. So if you think that the market is going down, you sell the securities and hold cash. If you think the market is going up, you convert the cash again in securities. Okay? So you try to time the market. You try to identify times when the whole market moves up or moves down. Okay? So like, let's say there is the US regularly, quarterly, or at regular intervals publishes unemployment data. And if you have strong beliefs that the data will be bad for the market, you sell before the publishing of those unemployment data. And then the market goes down if you're right, and then you buy again. That would be market timing. Okay? So all of that, all these active management strategies, they rely on the assumption that markets are not fully efficient. If markets are fully efficient, that means that all the information that is available is already included in the prices. Meaning that all that you can rationally expect about the unemployment data is already included in the price. All that you do in your term project, all of these information that you collect, they are already included in the price. So if they are already included in the price, well, you cannot beat the market because, well, the market price is the most efficient estimate of the true and accurate value. Okay? So if markets are fully efficient, then actually active management doesn't work. If markets are fully efficient, it's better to do passive management. Passive management means you do not try to find undervalued securities and you are not trying to time the market. Instead, what you do is you simply buy the whole market, like a broad index, and you hold that for a long period of time, like a couple of years. So you're not going in and out, and you are not selecting securities within an asset class. If your asset class is US equity, you just buy a broad US equity index, you are not selecting any securities, and you are not timing the market. You are just buying it today, holding it for 10 years, or holding it over your investment horizon. Okay? So the buzzword for passive management would be ETFs, exchange traded funds. Right? I mean, they have become very, very popular in the last years, because more people now do passive management. Active management, that's what mutual funds are doing. You have a fund manager, And the fund manager's job is really to find these undervalued securities and to time the market. Okay. Globally, what we see, but I will show you that at one of the last lectures. What we see is we see a lot of money going out of active strategies into passive strategies. Active strategies are still dominant because they start like 20 years ago. That was the only way of investing, basically. But passive strategies are catching up quickly. Okay. Hong Kong is kind of interesting because it's an exception that active management is still very much dominating passive strategies. So passive strategies for Hong Kong investors play a very, very tiny role, which is not what they do now in the US and the Europe. In the US and Europe, they are playing a bigger and bigger, much bigger role. Okay. What I will also show you is quite a bit of empirical evidence on whether passive or active is better. So what gives you better returns? And the very quick preview is that most evidence we have suggests that active management cannot outperform passive management. Meaning that markets are so efficient that these timing strategies and finding these undervalued security strategies, they do not work. At least on average, for the average fund. Okay? Because they do not seem to work, these funds have trouble kind of outperforming passive strategies. And once you subtract their cost, they even underperform passive strategies. Because you can imagine that active management, if you run a fund and you do active management, I mean, that is much, much more expensive than doing passive management. Right? I mean, consider you set up a fund that does active management. You need to hire people, right, to select the stocks, to do the market timing. You need to subscribe to Bloomberg, Reuters, to all these databases to get all the information. It's very expensive. I mean, what do you need for passive management if you set up a passive fund? Basically, you need a computer, not even a very good one. You just buy everything. It's very simple. And you're not buying and holding. You're not buying and selling, actually. You just hold the market. Of course, the devil's in the detail, and there are also some things that make this a little bit complex. But broadly speaking, this is a very, very cheap strategy, and this is a very expensive strategy. And that is what we see more and more, that because of the high costs of the active strategy, those active funds have trouble keeping up with the passive strategies. Good. So let's have our second break. And again, let's do 10 minutes and then we continue. Okay, so last part for today. So, before we move to the section where we look into asset classes, I just want to make one thing a bit clear, and this is, what are financial markets actually, or what do financial markets exactly do? Because that sometimes is a bit of like unclear, I think. Okay, so the best way to do that is by looking at this picture. So in this picture we have this yellow box and the green box, and those two are the starting points. So these are lenders, savers, and borrowers, spenders. Okay, so in the yellow box we have what we can probably call entities that have excess cash, excess funds. And in the green box, we have entities that are in need of funds. And those entities can be firms, governments, households, or like foreign countries or foreign people. So the basic problem now is, how can we ensure that the money can flow from the yellow box to the green box? If money can flow from the yellow box to the green box, this will be good, because then people who have excess funds they will have an investment opportunity for their excess funds. And people who have need of funds, they can actually obtain the funds and probably start their business. Okay? So let's do a very small, stupid example, kind of. Let's say we have a person who is in the yellow box and a person who is in the green box. Let's call the yellow person the cash-rich person. Let's call him Jack. Okay? So what is Jack's situation? Well, Jack has a lot of money. Probably he inherited a lot of money, or I don't know, probably he found it somewhere. Unfortunately, Jack is not very talented, and he does not want to start his own business because he has no good business idea, and he knows he's not very talented. So Jack will not start the business, but he has excess cash. And then let's say in the green box, we have Amy. Amy, unfortunately, is very poor. She has no money. But Amy is very talented. She has a great idea. She studied chemistry and found a way to create new batteries for cars or whatever. But she needs funds to start this business. So all that we have now to ensure is that the money can flow from Jack to Amy. And that will be great, because then Jack will earn a return on his money and Amy will start her business. And Amy will employ new people, so no more people come into employment, they have wages, their families can live, so this will be great for the economy. Okay? So basically there are two ways how the money can flow from Jack to Amy. There's a direct way and an indirect way. We are mostly talking about the direct way here. So the direct way is via financial markets. So the whole idea of financial markets is that Amy and Jack can now meet. And Amy and Jack can write a contract, and Jack can transfer his money to Amy. It's basically a way for both to get to know each other. So they directly meet at the market. Okay? And they write a contract to transfer the funds. So Jack goes to the financial market, Amy goes to the financial market, they meet, write a contract, funds transfer. So what would be a real life example of actual financial markets of such a transaction? Or let me probably ask this question slightly differently. If you go to the market now, or on your phone, and purchase a stock, would that be a good example for such a situation? No. Why? Right. You're not buying the stock from the firm, right? You're buying the stock from another investor, a trader. Okay? So if you typically buy a stock, the money that you invest in the stock, this is not money flowing to the company, this is just money flowing to another investor. Okay? So this would not be a good example for this situation. What would be a good example for this situation? When do we have actual flow of money from the investor to the company? Well, during the IPO, right? Whenever the company actually sells its securities directly to the investor, and that would be the case in the IPO case, during the IPO, and all following SEOs, seasoned equity offerings. Okay? Only in these cases, the money is actually flowing from the investors to the company. And this would be the equivalent to Amy and Jack. Right? So modern financial markets are good examples of this. Amy and Jack meeting each other and transferring money, but only during specific time periods, which is IPOs and SEOs, not in the secondary market. Okay? So this is what we will mostly talk about, trading on the financial markets. Nearly exclusively talk about. The second way how the funds could be transferred is the so-called indirect finance way. It's via financial intermediaries. And it's called the indirect way because in this case, if money flows this way, Amy and Jack, they never meet each other. They do not even know that they exist because they have two separate contracts with a financial intermediary, like, for example, a commercial bank. So Amy puts her money or gives her money to a financial intermediary, and then they have a contract, and the financial intermediary then later gives the money to, Jack gives the money to the financial intermediary, and then later the financial intermediary gives the money to Amy and she starts her business. So this is the prime example of what commercial banks are doing, right? They collect deposits, like Jack using a savings account, depositing his money at HSBC or Citibank or Bank of China or whoever, and then Bank of China, they kind of collect all the money, the deposits, and they grant a loan to a corporation. The corporation doesn't know that the money they are just receiving as a loan, that this comes from you and you and you and me, because we are all small depositors, right? And if we have a savings account, we don't know what the bank does with our money, because we have a separate contract with the bank about our savings account here, and the bank has a separate loan contract with the corporation. So this is the indirect way. Okay? Those are the two ways. We will mostly focus on financial markets, on trading on financial markets, also secondary trading. But this is really just, I kind of really like this picture because it gives us a bit of a background what we're actually talking about, why this is important for the economy or even the society. Okay? What do you guess? What is more important, indirect or direct finance? How is more money flowing? Indirect or direct? Indirect? Who thinks indirect? Who believes direct? Yeah, indirect. Many times more important. So direct is only really important for large firms and actually for highly developed markets like the US, but for smaller firms and for most markets outside the US, indirect finance is by far the more common way how money flows from investors to firms. Okay? Good. Yeah, the role of banks, commercial banks, I think that is pretty clear. Investment banks, just to make sure, but you know that. I mean, investment banks have nothing to do with commercial banks, right? They are not taking deposits, making loans. Basically, investment banks, they play a role in the primary market when firms do IPOs, SEOs. So basically, they help firms on the primary markets. So they're very different from commercial banks. Yeah? Now let's talk a bit about asset classes. There are multiple ways how we can classify asset classes or how we can distinguish asset classes, and it's not even also clear often what exactly an asset class is. So consider this as one way to kind of classify asset classes. So I split here money market and capital market instruments. And the difference is that money market instruments are short-term instruments and capital market are long-term instruments. Okay? So money market instruments and capital market instruments and bonds, equity, derivatives would typically counted as capital market. But it's not always super sharp. So this distinction, honestly, is also not super important. It's just a way to make it easier to present stuff. So the money market. The money market is surprisingly important and at the same time surprisingly not very well known. Okay, so money market securities, they all share three features. So these three features are basically used to define, to classify a security as a money market security. Large denomination, typically above 1 million US dollars. Which is probably why it's not that well known, because we, at least I or most of us, I guess, we will not directly participate in this market because you need at least $1 million to actually buy stuff in this market. Okay? So it's typically not open to private investors. The second feature of these instruments is that they have very, very low default risk. And the third feature is that they have a short maturity. So most of these instruments have a life of less than a month, 120 days being the maximum, but that is already rare. Mostly we are talking about days, at most probably weeks. Okay, so very, very short term. So it's often kind of confusing why these markets are so important. And one way why they are so important is because they provide firms an opportunity to store excess cash. Okay? So the main purpose of these money markets is to provide investors a storage place for cash. So that is sometimes necessary because, especially in the case of corporations, they often have not very well synchronized cash inflows and cash outflows. So if you consider you are running a company, typically you have cash inflows during all the month. Like, let's say you run a restaurant. You have cash inflow every day. But your wages to your employees, they are paid at specific time points. Let's say at the end of the month. So you are taking in money during the month, and then you have to pay the money at the end of the month. So what you would do then is you would take the money that you earn during the month, invest in money market securities, and at the end of the month you sell the money market securities and pay the wages. You're not doing that if you're a small restaurant, but if you're Apple, you do that. Right? I mean, because Apple is taking in billions. And even if they only earn a tiny return on this money over a couple days, that's still a lot of money. Okay? So, and firms actually hold a lot of cash, and this is what this pictures try to show. So the size of the money market or the importance of the money market is closely related to the fact that firms actually hold surprisingly high levels of cash. So this is the first picture I want to show you, and this is corporate cash holdings. So basically they sum up the cash holdings of all the corporations in a country, and they divide that by the country's GDP. So in Japan, this is a crazy 40%. So the cash holdings of Japanese corporations account for 40% of Japanese GDP. In Germany, it's like 20, and in the US, it's still 10. So if you just think about raw numbers, I mean, this is just crazy how much money is piling up on the balance sheets of corporations as cash. And I show you a kind of a drastic illustration of that in a second. But basically, this is dead money. And I mean, this is lying around as cash. This is not creating jobs. This is not creating innovation. This is just lying there. It's not doing anything. In a world without frictions, it would be very hard to understand why firms do that. Because firms should invest the money if they have good investment opportunities. And that can be R&D, or that can be they build a new factory. If they do not have good investment opportunities, they should simply pay it out to their owners as dividends or via share repurchase programs. So why firms keep so much cash on their balance sheets is actually a kind of a little bit of a puzzle, and we don't know exactly the correct answer to that. So this is the case of Apple, just to give you a bit of a feeling of how crazy the numbers are. I mean, Apple didn't hold a lot of cash in the 90s and early 2000s, but that was also the time when Apple was not very successful. So then actually the cash on Apple's balance sheet kind of increased and increased and increased, and it peaked at nearly 300 billion US dollars. This is one firm only, and it's still at like 200 billion US dollars. And keep in mind, this is dead money. It's not doing anything. It's just lying there. It's not creating jobs. It's not creating innovation. It's not doing anything. It's just cash. And you find that not only in Apple. Apple is a kind of extreme example. They hold crazy amounts of cash. But also other firms hold a lot of cash. So if you look at, I don't know, Google or Pfizer or Johnson & Johnson, Intel, I mean, many of them hold a lot of cash. So this is the illustration that I was talking about. It's basically dead money. It's piling up on the balance sheets of firms, doing nothing. Yeah, and probably it's not very efficient for the economy as a whole. Probably it's good for the firms themselves, but not for the economy as a whole. Okay. So that's kind of it's actually an interesting question why firms hold so much cash, and there is research going on in that areas, and there are some answers to that, but it's still an interesting field, I would say. But that's not, I just wanted to kind of mention that briefly. The main point for us here is that really firms have so much cash, so they need money market. They need to store that cash somewhere. Because, I mean, you can imagine, like 300 billion US dollar, Apple probably will not keep that as physical cash in a vault or something like that, or somewhere in its headquarters. I mean, it's a bit too much. Risk would be too high. Good. So what can Apple do? How do they invest this money? Well, these are the money market instruments that are typically used for not only for that purpose, but this is a more general overview. Treasury bills, so these are very short-term US government bonds, repos, and I will talk about them a bit, and there are a few others. So actually it's not that important for us to know all the details here. I just want to kind of give you a bit of an overview on the money market, and I want to talk a little bit about the repo market because it's a very big market, global size above 10 trillion US dollars. And again, it's surprisingly little known. In practice, this is highly relevant. In academia and university settings, we often kind of tend to forget about it. So the repo market is actually a very simple market. So what happens is that you have a person, and the person has Treasury securities. Treasury securities is simply like securities issued, bonds issued by the US government. Okay? So one person has treasuries. Let's call her Amy again. Amy has treasuries. So Amy now needs cash. But Amy doesn't want to sell the treasuries because long term she wants to keep her treasuries. So she's reluctant to sell the treasuries. She wants to keep them. So what Amy can now do is she can go to the government, to the repo market and say, look, I have treasuries here, but I need cash. Would somebody please give me $1 million US dollars, which is the value of my treasuries, and I can transfer my treasuries as a collateral to this other person. And now Jack comes and says, oh, that's amazing, because I have $1 million cash lying around. I just want to have a little return on it. It's just like a 1-week investment. So give me your collateral. So this will make it very, very unrisky for me. I give you the $1 million, and we have a deal. And this is a repo. So Amy transfers the collateral to Jack. Jack gives her $1 million. After 1 week, they do the reverse transaction. The collateral is transferred back to Amy, and Amy pays back the $1 million plus a little bit of interest. Okay? That's why we call it a repurchase agreement, because the treasuries are repurchased. It's actually a misnomer. They're not repurchased, they're re-exchanged after a week. Okay? So that's the basic setup of this market. So it's essentially a short-term collateralized loan. Very short-term collateralized loan. Very low risk. Because Jack, who is the lender, I mean, his risk is close to zero, right? If Amy runs away and says, oh, I take your million and now I move to the Bahamas and never seen again, I mean, Jack says, so what? I mean, I have your treasuries, I just sell them. And he gets the million from selling the treasuries, so he doesn't care. This is a very, very low risk deal. Okay, so this is how you have to think about the treasury market. Okay? And let me show you a very short video clip that explains that probably better than how I explain it. One second. So,
A repurchase agreement is the equivalent of a short-term collateralized loan. An owner of marketable securities sells those securities to a buyer for cash. As part of the deal, the seller agrees to buy back the securities at a later date. That later date can be the next day, or maybe the next week. The price paid to repurchase the securities is higher than the original selling price. The spread between the original price and the repurchase price is equivalent to interest. Repurchase agreements are often used by institutions with available cash that are looking for quick, easy ways to get a return on their money with little risk. Shelley has $1 million in treasury bonds. Lindy has $1 million in excess cash and wants to earn some revenue without tying it up in a long-term investment. Shelley is the seller and borrower in the repurchase agreement. Lindy is the buyer and lender. Shelley agrees to sell the treasury bonds for $1 million, but on the condition that she buys them back from Lindy next week for $1 million plus an additional $956. The $956 is considered the equivalent of interest. One risk to keep in mind, the original seller might be unable to repurchase the securities. In that case, the buyer has the right to sell the securities on the market. To mitigate this risk, repurchase agreements are usually collateralized with securities with a market value in excess of the amount paid for them.
Yes. So just 1 second to set this up again. So, sorry, that's still a bit, some glitches. Okay, so that's the money market real quick. Now let's go through the bond market. So again, bond market, what means bond, publicly traded, yeah, and typically a bit longer term than this extreme short term money market securities, okay? So we have couple bond market instruments, government bonds, inflation protected bonds, munis, corporate bonds, and we have our mortgages and mortgage-backed securities, which, as some of you might remember, although that is a long time ago, they were kind of in the center of public attention during the financial crisis in 07, 08. Because they, I mean, I probably wouldn't say they caused it, but they significantly contributed to it. Okay? We will talk about that and also connect it a bit to this financial crisis. Before we talk about the details of the bond market, sorry, let me just show you this picture, which makes a pretty similar point to the one of the first, probably the second slide or so I showed you today. Remember about the financial assets and relative to GDP. So what this here shows is the bond market, or the amount issued and every year by stocks in purple and bonds in green. So these are billion US dollars. So, and the point I want to make here, or what I want to make here again, is that in every single year, the amount of money issued via bonds was many times higher than the amount that was issued via equity, via stocks. So again, this common misperception that equity is more important than debt, fixed income, it's just not true. Okay? In terms of financing, fixed income is more important. This is only bonds, right? I mean, this does not even include loans. But even only looking at bonds, it's many times more important in every year than equity. So let's look at some of these bonds. I mean, government bonds, the definition is pretty straightforward. It is a government bond if the issuer is a government. So most countries, governments around the world do that. US, Canada, China, Spain. The Hong Kong government also issues bonds. So it's very easily available in the sense that many governments do it. And it is often used to approximate the risk-free investment rate in a country. So often for asset pricing, or also for the theory models that we will talk about in the next lectures, we talk about something that we call the risk-free asset, which immediately raises the concern, I mean, what is the risk-free asset in reality? Right? And unfortunately, that is not very easy to answer, but what is most of the time, what is often used to approximate the risk-free rate are government bonds, US government bonds. But sometimes you need, US government bonds are not that helpful because you need the risk-free rate in a specific country that is not the US, so you would also then often use the bonds issued by that government. Okay? Are these bonds, and let's talk mostly about the US now, are these bonds really risk-free? Well, most likely not, because governments default for multiple reasons. The interesting thing is, and that's why I want to spend a minute or probably 2 or 3 minutes here talking about that, is that governments actually, they do not need to default. If you are a government, you don't need to default. You issued bonds, you can always repay. Why? Yeah, I mean, this is what he says. The US will never default because it prints the money. Okay, story closed, risk-free, let's go home. No. But why do countries then still default? I mean, you follow the news, right? I mean, countries default. I mean, in the last 50 years, I mean, Russia defaulted, Argentina defaulted, some other countries defaulted. Why did they not just print the money? I mean, there were some special cases, right? Like, for example, the Greek case in the Eurozone debt crisis when Greece was close to defaulting. I mean, Greece had the problem that they couldn't print their own money because they were part of the Eurozone. So in those cases, this is not a valid argument because you cannot print your own money if you're part of a currency union. But most countries aren't part of currency unions. Argentina wasn't, Russia wasn't. So why did they default? Yes, they don't want the hyperinflation, right? If you print the money, you get crazy inflation, and you don't default, but you get very high inflation levels. And that's very bad for your economy, okay? And additionally, your investors are probably still very upset because if you print money to pay your debt back, at least your foreign investors will be very upset with you because, yeah, they get the money back in nominal terms, but the exchange rate will be very bad because of your hyperinflation. The value of your currency will deteriorate crazily, and in terms of US dollars or euros or wherever the investor is from, they still get nothing or close to nothing. Okay? So for countries, there is this trade-off between defaulting and not defaulting. Not defaulting means printing money, hyperinflation, like simplified. Defaulting means no hyperinflation. And what you have to keep in mind is that countries typically choose the default option, so that's why this is not very, I mean, it's right in its core, but it's not true in a sense. Countries do not face a lot of consequences when they default. If a company defaults, I mean, what happens is that somebody comes, a court hires somebody to go into the company, basically collect all the assets of the company and sell them, right? Everything is sold and the company is gone. I mean, it just disappeared. If Argentina defaults, I mean, Argentina is not disappearing. And nobody's coming and selling the streets in Argentina or selling the government properties. Nothing happens. Yeah? If you're an investor and you hold an Argentina bond and they decide to default, I mean, basically that's it. There is no way you can do anything. So it's very different to companies. So the only negative consequence from default, more or less, for countries is that investors are upset and they are not willing to lend them money anymore, right? But even that, historically, we know, I mean, that goes away over time. Right? Investors tend to forget, and a couple of years later, they say, oh, probably we should lend money to Argentina again. Or, I mean, what also happens often is like you have a new government. Like the new government says, oh, look, this old government, these were bad guys. They defaulted. Now we are kind of running the country. You can trust us. Give us money again. And then the investors think, oh, yeah, maybe we can do that. So the point I want to make here is really just governments default. Okay. Also, they technically probably don't have to. They do in practice. So if we buy government bonds, that's not equivalent to risk-free at all. Even for the US, that is most often used as a proxy for risk-free, it's not. Countries can default for multiple reasons, including political ones. And this is probably in the US the biggest danger. And this is a picture, I think this is from 2011, but probably the same picture is in the newspapers today, because this debt ceiling crisis is something that reoccurs all the time. And now, exactly now, the US also has a debt ceiling crisis. So the debt ceiling crisis is something very simple in a sense. The US has a debt ceiling, a maximum amount of debt that they can issue. That's, for simplicity, this is just a law, and you cannot break that law. So whenever you approach that ceiling, you have to increase the ceiling. And that's a political process, and typically both parties have to agree to that. So now, if for political reasons they cannot agree to increase the ceiling remains constant. So you are approaching the ceiling and you are risking to default. Because let's say the ceiling is 100 And now if you are at 99.9 and a bond matures, you have to repay the money to the bondholders. And how you always repay the money is via issuing new bonds. I mean, if a large bond tranche matures and you have to repay a couple billion, nobody has a couple billions just lying around waiting for repayment. So basically, one bond matures, you roll it over, you issue immediately a new bond, you take the money from the new bond to pay the old bondholders. But suddenly you cannot do that anymore because you are at the debt ceiling, so you are not allowed to issue a new bond. Okay? And there is an actual risk that at some point, maybe for political reasons, they play this game too hard or too long. And there is a technical default. So probably this will never happen. But at least the markets, and this is from 2011, there was some betting in the markets that the US could default because of that. Okay? Again, the point I want to make here is governments can default, and it's not only the governments where it's more obvious because they have actual recessions or depressions or actual real big economic issues. Governments sometimes can also default for other reasons, like political disagreement of the parties in these countries, for more technical reasons. For the investor, at the end, it doesn't matter. You don't get your money. Okay? So, in short, nothing's risk-free. Even the proxies we use for risk-free, they are not risk-free. They are probably somewhere close, but they are not risk-free. Okay? Good. So this is just a bit of an overview. This is what you get now. This is pretty much up to date. If you invest in 10-year government bonds of different governments, so these are all 10-year bonds, and those are the yields of the 10-year bonds issued by these governments. What is the yield of a bond? Well, this is the return on your money that you get annually if you buy the bond now or on January 19th and hold the bond until its maturity. So you hold the bond for the full 10 years. Then you get exactly this yield under the assumption that the issuer will not default. Okay? So that's why it's fixed income. If the US will not default and you purchased the day before yesterday a US government bond, you will get 3.37% every year, period. That's it. You know it. Okay? Fixed income. So right now, interest rates, yeah, they went up. I mean, guess you followed that. I mean, I show you the time trend on the next slide. They went up quite a bit in the last 12 months. So now we have 3-point-some% in the US. In UK, also 3%. Germany a bit lower, 2%. But yeah, somewhere between 2 and 4% for the most developed countries. So that's kind of what you get right now. There are some exceptions, of course, countries with a higher economic risk, like Brazil is significantly higher. Then we also have India, which is also significantly higher, about 7%. And some exceptions, like Japan, which is still very low, close to zero, because of more monetary policy related reasons. Okay? But right now, again, for highly developed countries, you get somewhere between 2 and 4%. Okay? So if we look at the time trend, this is US 10-year government bond yields from the 1960 to today. I mean, it's still, historically speaking, low. So most of the time you would get higher rates than 3%. So with a peak of about 15% in the 1980s. But it increased a lot. I mean, it was close to zero 2 years ago when COVID started. And now it's like 3-point-some%. Okay? So, to some degree, of course, this government yields also reflect inflation. Right? So the fact that it was so high in the 1980s is also related to the extremely high inflation in the US during the 1980s. So it was not, I mean, if you look at that picture only, it seems like a golden time for investors because you can get 10-15% return for US government bonds that are relatively risk-free. But it was not that great because inflation rates were super high, so you needed 10-15% to keep your purchasing power, basically. Okay? So when we look at historical interest rates, we always have to consider the inflation environment at that time. So the last point for today that I want to show you is that this is actually the German government bond yield, the Bund view, the Bund about 2% here, but that's and that's the time series, the last 4 or 5 years. And there you can see something that you don't see in the current yields. Most of the time, in the last 4 or 5 years, the German bond yield and the Swiss bond yield and also the Japanese bond yields were negative. Okay, so that disappeared now. We are not seeing negative yields anymore. So this is actually the first year since many years that I showed this slide without a negative yield on it. But we know that in the past years we had this situation quite often, actually, negative government yields. So this is just an overview on negative government yields. So especially Japanese debt, Japanese bonds. There is a lot of Japanese bonds, 4.8 trillion, that have negative yields. Also France, Germany, Spain, Netherlands, and some other countries. So Switzerland would also be somewhere here. Okay? Yeah, it's not that important. So we can skip that. So when this first occurred, probably in 15 or so, that government bond yields turned negative, people were really kind of shocked because, like, the textbook wisdom, the textbooks say basically this cannot happen. Government bond yields are positive. But suddenly they were not. Suddenly they turned negative. And it's really kind of surprising if you think about it. Why would somebody buy a government bond that has a negative yield? Which literally means you pay to the German government today 1,000 euros and you get back 960 over the next 10 years. Why would anybody do that? The fact that the yields are negative means that people are doing it because the yields are at the end the outcome of supply and demand. There's trading. The trading determines the price of the bonds, and then the price is inversely related to the yields. So people were really, really willing to buy bonds with negative yields. Why? Seems very stupid. But why did people still do it? And you have to think about it from two directions, I think. The first is, some people, some players in the market, they simply had no other choice. I mean, you as a private investor, instead of buying that German government bond, you could just take your 1,000 euros and keep them at home. Right? Or deposit it at a savings account that even at that time gave you 0%, but not negative. But if you're a pension fund and you have, I don't know, 5 billion euros under management, there is no savings account for 5 billion euros. You cannot keep 5 billion euros as cash. I mean, you can technically, but I mean, the risk is enormous. I mean, imagine somebody steals the money, it burns, or you lose it, or some of your employees take part of it. I mean, you would have to hire an army to protect that money. I mean, that would also be crazy expensive. So for some market players, they just had no other choice as to buy these bonds. They didn't like the fact that the yield was negative, but there was no other choice. They had to, okay? Private investors, of course, they would never do it. But pension funds and other large professionals. They had to do it. And the second thing is that quite a lot of speculators also purchase those bonds. Because remember what I told you, the yield, this negative yield, this is what you get if you buy the bond today and hold it for 10 years. But nobody forces you to hold the bond for 10 years, right? You can sell the bond tomorrow. So what they were actually doing, the speculators, is they were purchasing those negative yield bonds. They never intended to hold it for the full life of the bond. They just were hoping that the price of the bond would go up, meaning the yields become even more negative, and then they would sell the bond with a gain. So you can still buy negative yield bonds and make a gain. But it's a speculation. You hope that the price goes up. It's in a sense, this return is not fixed, of course. You hope that the price of the bond over time goes up, and then you sell it. You can still make money. And that's another reason why people still really purchase those bonds, because they were hoping to still make money by price changes. Okay? Good. Thank you very much for your attention. Happy Chinese New Year. And I see you in 2 weeks.